Welcome to Stock Talk. If you're keen on understanding what makes companies tick, especially, within the stock market, then you're definitely in the right place.
That's the goal.
We aim to give you that shortcut to being well informed. Today, we're diving deep into the latest numbers from a company that's, well, a household name, particularly when that pizza craving hits. Domino's Pizza Inc.
That's right. DPZ.
Yeah.
We've got their first quarter 2025 financial results, which just dropped on April 28th. And Domino's, it isn't just your average pizza place.
No, they're huge.
They hold the title of the world's largest pizza company. So their performance really gives us some interesting clues about consumer behavior and maybe the wider economy, too.
Okay, let's unpack this then. Our mission today is to really dig into this financial report, pull out the most crucial insights, maybe even find a few things that might surprise you.
Sounds good.
So kicking things off, what were the big takeaways, the top line figures?
Well, at a glance, it's a bit of a mixed story, actually. Globally, their retail sales saw a healthy increase, 4.7%. And that's, excluding the foreign currency impact.
Okay, 4.7% global growth sounds pretty decent.
It does. But
Yeah.
that overall global growth kind of masks a pretty significant difference in how their U.S. and international markets are performing. That's something we'll definitely need to explore more.
Ah, okay. That divergence. Were there any other headline numbers that immediately, jumped out at you?
Absolutely. For the first time in recent memory, Domino's actually saw a net decline in their total number of stores worldwide during the quarter.
Really? A decline?
Yeah, a net loss of 8 stores globally. Now, on the flip side, we saw their net income jump up by a solid 18.9%.
Okay, that's strong.
And their diluted earnings per share, basically the profit per share, considering all potential shares, that rose by an impressive 20.9%.
Wow.
And maybe most striking, their free cash flow, the cash left after operations and capital spending, saw this huge surge, 59.1%.
Hold on, a net decrease in stores. That feels like a really notable shift for a company that's been expanding so consistently. Okay, this is where it gets interesting. Let's get into the factors driving these numbers. Starting with revenue, where's the money coming from?
Right, so total revenues hit $1.11 billion. That's up 2.5% compared to the same time last year. Several things played a role here.
Like what?
In the U.S., revenues from franchise advertising were higher. That was partly due to a change in how they structure their advertising contributions, which we can get into.
Okay.
We also saw an increase in their supply chain revenues. That's a big part of their business.
Right, selling ingredients and stuff to the stores. But can you break down that advertising contribution change a bit more? What does that actually mean for the franchisees?
Certainly. It looks like Domino's scaled back some specific advertising incentives they had tied to certain brand promotions. Plus, they went back to their standard 6.0% advertising contribution rate at the start of Q2 last year.
Ah, it had been lower.
Yeah, it was temporarily down to 5.75%. So essentially, franchisees started contributing a slightly higher percentage of their sales back into that advertising fund.
Got it. Makes sense. And what fueled the increase in supply chain revenue? Was it just more volume?
Well, it was primarily driven by a 4.8% increase in the price of the food basket, so the ingredients and supplies they sell.
Okay, price increases.
But it's important to note that was partially offset by a couple of things. They handed over their equipment and supplies business to a third-party supplier. That had an effect. And also a change in the mix of products being sold.
Right.
And we shouldn't forget the international side. They saw higher franchise royalty and fee income there too, although, currency exchange rates did dampen that growth somewhat. Always a factor.
Always a factor with international business. Okay, so revenue's up slightly. What about profitability? How did that translate to the bottom line?
Yeah, this is interesting. Income from operations actually saw a tiny dip, 0.2%. But if you strip out the currency impact, it would have shown a 1.4% increase.
So currency really hit them there. What else was going on?
Well, what's kind of fascinating here is that this was impacted by about $5 million in severance expenses. Looks like they had some restructuring within the organization.
Ah, okay. Restructuring costs. But wait, you said net income jumped significantly earlier.
Yeah.
How does that square up?
Right, good catch. The big increase in net income, that 18.9% we mentioned, wasn't really driven by operations. It was mainly because of a favorable adjustment in the value of their investment in DPC-LTD.
An investment gain.
Exactly. Gave them a significant boost on paper. Now, on the other side of the coin, their effective tax rate did go up. That was mostly due to a less favorable change in tax benefits they get from stock-based compensation.
Okay, so a bit complex there. And that higher net income plus share buybacks ultimately drove the strong growth in diluted EPS, right? The earnings per share.
Precisely. Higher net income combined with them actively buying back their own shares that led straight to that impressive 20.9% increase in diluted EPS. Fewer shares outstanding means higher earnings per share, all else being equal.
Right, makes sense. Okay, now that we have a good overview, let's zoom in. How did each of their different business segments actually perform?
Okay, segment by segment. Their supply chain segment is still the biggest chunk, making up over 60% of total revenue. It saw modest growth, 1.6%.
Just 1.6% growth for the biggest segment.
Yeah, but what's particularly interesting is that its gross profit margin actually improved. They flagged procurement productivity, basically, getting better deals or lower costs on the supplies they buy.
Okay, so efficiency gains there. And how about the more traditional side, the franchise royalties and fees here in the US?
U.S. franchise royalties and fees showed really slight growth, just 0.3%. And this is despite a small dip in same-store sales, or SSS, as it's often called.
That sales from stores open at least a year, right?
Exactly. So that suggests the new franchise stores they've added over the past year are probably helping to offset some of that softness in sales at the established locations.
But the stores Domino's owns directly, the company-owned ones in the US, they seem to be facing a bit more pressure.
That's correct. U.S. company-owned stores saw revenue decrease by 1.1%, and their same-store sales fell by a more significant 2.9%.
Ouch.
Yeah, and their gross margin took a hit too, likely due to those increased food costs we mentioned, and also the fact that lower sales mean less leverage, harder to spread your fixed costs effectively.
Right, less efficient. Now, you mentioned the international segment earlier. Sounds like that was the bright spot.
Absolutely. International franchise royalties and fees showed strong growth of 5.0%, and that's after accounting for negative currency impacts.
Wow, so underlying growth was even stronger.
Potentially, yeah. This growth came from both robust same-store sales internationally and an increase in the number of international stores compared to last year. Real strength there.
Okay. And finally, that U.S. franchise advertising segment we touched on.
Yes, that saw a pretty significant jump, 12.4%. But again, that's largely down to those changes we discussed. Fewer incentives, and going back to that standard contribution rate. More structural and operational, perhaps.
So definitely a really varied picture across the different parts of the business. Let's circle back to that surprising net decline in store count. What's the story behind the story there?
Right. The global net decrease of 8 stores. It happened because the number of international store closures actually outweighed the growth they saw in the U.S.
Ah, so U.S. stores still grew.
Yes, in the U.S., they had a net addition of 17 stores. That was 20 new franchise openings and 3 franchise closures. Their company-owned store count stayed flat.
But it sounds like the international side saw a fair number of closures then.
Exactly. While they did open a respectable 203 new international locations in the quarter.
A lot of openings.
It is. But they also closed 228. That led to the net decline of 25 stores internationally. So, yeah, this is definitely something to keep an eye on.
Why do you think that's happening internationally?
It could be several things. Maybe focusing on more profitable markets, consolidating weaker areas, perhaps franchise challenges in specific countries. While international expansion has been key, this quarter might suggest a bit more strategic pruning or adjustment.
Okay. But it's important that, to put it in context, their overall store growth over the last year is still pretty strong, isn't it?
Yes, that's a crucial point. Don't want to overstate one quarter. Over the trailing 4 quarters, they've still added a net of 603 stores globally. So this single quarter might be a blip, or just reflects specific adjustments in certain markets right now.
Right. Context is key. Let's shift focus slightly to same-store sales again. You mentioned that divergence earlier between the U.S. and international. Can you elaborate on that difference?
Sure. So in the U.S., overall, same-store sales dipped slightly, down 0.5%. When you break that down further, the company-owned stores had that steeper decline we saw, maybe of 2.9%. Franchise stores were down just 0.4%.
Okay. What factors might be driving that dip here in the U.S. competition economy?
Could be a mix of things. Increased competition is always there in the pizza space. Maybe greater price sensitivity among U.S. consumers right now, given the economic backdrop, or even just shifts in how people are spending their discretionary income.
And in fact, company-owned stores did worse than franchises.
Yeah, that might suggest some differences in, say, local execution, maybe localized market challenges hitting those specific stores harder, or perhaps different pricing strategies. Hard to say definitively from just this.
But the picture internationally sounds much rosier on the SSS front.
Absolutely. International same-store sales grew by a robust 3.7%, and that's excluding currency impacts. What's interesting is this is actually an acceleration compared to the growth rate they saw the previous year internationally.
Acceleration. Okay, so international momentum is building. And despite these headwinds in the U.S., it sounds like management still feels pretty good about their market position.
Yes, they definitely made comments suggesting they believe they continued to gain market share in the quick service restaurant pizza category, both in the U.S. and internationally, even with those domestic SSS challenges.
So they feel like they're outperforming the overall market, even if their own U.S. sales are flat to slightly down.
That seems to be the message, yeah.
Interesting. Okay, let's talk cash. The business generating cash, how they're using it, capital allocation.
Right. They had a very strong quarter here. Net cash from operations was up a healthy 45.0%, and free cash flow had that massive 59.1% jump we flagged earlier.
What drove that big jump in cash flow?
It was driven by a few things. Positive changes in their working capital, things like receivables and payables. The timing of advertising fund contributions and payments helped. And significantly, a notable decrease in their capital expenditures.
Oh, so they spent less on building things out, equipment, etc.
Exactly. CapEx was down almost 27%. Looking at their balance sheet, they do carry a decent amount of debt. Their leverage ratio is 4.9 times. That gives you an idea of debt relative to earnings.
Is that high? Low, stable.
It's leveraged, but it's actually a slight improvement from the previous year. Their total debt amount remained fairly stable, but importantly, they saw a significant increase in their cash and cash equivalents on hand. So more readily available cash.
And they're still giving cash back to shareholders, too.
Yes, definitely. They repurchased $50 million worth of their own shares during the quarter. That's double what they bought back in the same period last year.
Okay, stepping up the buybacks.
And they also announced their next quarterly dividend payment, $1.74 per share, scheduled to be paid out at the end of June.
So it sounds like despite some mixed operating results, the cash generation is strong, and they're confident enough to return a good chunk of it to investors. Let's shift gears now to the bigger picture. Strategic direction, challenges ahead.
Okay. Their main strategy is still this hungry for more initiative. Pretty clear focus. More sales, more stores, more profits. They've really emphasized concentrating on the factors they can actually control internally.
Makes sense. But what challenges are they acknowledging?
They do acknowledge several key ones. The broader macroeconomic environment, obviously, ongoing pressure from foreign currency exchange rates that keeps popping up, that softening consumer demand we seem to be seeing, particularly in the U.S., and those organizational realignment costs, the severance we mentioned earlier.
And the CEO, Russell Weiner, his comments seem to really focus on that market share growth as the key metric, right? Even if same-store sales are tricky.
That's right. He basically underscored the idea that if they're consistently gaining market share, it shows they're managing the internal factors well, which they see as critical for long-term success.
Yeah.
Outperform the market.
Did they give any specific numbers for the rest of the year? Guidance?
Interestingly, no. They didn't provide specific quantitative guidance for how they expect the rest of 2025 to play out. That might suggest some level of uncertainty about the current economic climate, maybe makes forecasting tough.
Fair enough. Okay, finally, let's just quickly touch upon the key risks and opportunities they've kind of laid out.
Sure. On the opportunity side, continued international expansion, especially with that accelerating SSS growth, those supply chain margin improvements from procurement, their strong cash flow gives them flexibility for buybacks, dividends, maybe even M&A down the line. Their digital platform is a huge strength.
What percentage is digital now?
Over 85% of U.S. retail sales come through digital channels. It's massive. And of course, there's always the potential for the U.S. economic picture to brighten up.
Okay. And the flip side, key risks they're watching.
The risks include, well, continued weakness in U.S. same-store sales is probably top of mind. The possibility that international store closures continue to outpace openings, even if it was just one quarter. Currency volatility is always a risk for global companies. Elevated food costs, potentially squeezing margins, especially in those company-owned stores. And, that somewhat leveraged balance sheet is always something to keep an eye on.
Right. So bringing it all together then, what's the main takeaway you get from Domino's first quarter? The elevator pitch.
I'd say it's really a story of contrasting performance, wouldn't you? You've got real strength internationally, which is helping to offset some clear headwinds they're facing here in the U.S. market right now.
Yeah, that divergence is stark.
But overall, their financial results, especially cash generation, look pretty positive, and they remain clearly committed to returning value to shareholders. The hungry for more strategy, that seems to be the steady hand guiding the ship.
So you, the listener, as you digest all of this, maybe consider this. What does this noticeable difference, this divergence in performance between Domino's here at home and their international operations, what does that really suggest about where their future growth might be most concentrated?
Good question.
And how might they strategically tackle those headwinds in the US while really trying to capitalize on that international momentum they seem to have? It's definitely worth taking a closer look at their full financial reports and, keeping an eye on the broader trends in the restaurant industry to get an even deeper understanding. Thanks for joining us for this deep dive into Domino's Pizza's first quarter performance on Stock Talk.